Good morning. It's Wednesday, March 4th. Here's what's on the agenda. The biggest South Korean stock crash ever. Oil keeps surging on day 5 of the US-Iran war, and Washington threatens Spanish trade.
So, Lizzy, on the markets, it is that focus on the Kospi in Korea. It is what the impact is being felt across the Asian benchmark then. The MSCI is Pacific down 4.2%. But to your point, is the Kospi closing down about 12%. The concerns, of course, rippling through the South Korean economy and the gains that have come through year to date. Those gains are still there, but clearly the selling has been significant. European stock futures, interestingly, looking to break higher after losses of about 4.5% so far this week, looking to add 6 points. Maybe a bit more stability building into the European picture with all those question marks that remain around the conflict in the Middle East. Brent crude prices higher again, looking through those reassurances coming through from President Trump, not finding that reassurance at this point. Prices up 3% on Brent, $83 a barrel, closing in on $84 a barrel. Oil prices remain, of course, central to the story out of the Middle East and how markets react. The countdown to the opening trade starts right now.
Good morning, everybody. Welcome to the opening trade. It is Wednesday, the 4th of March. Let's unapologetically go straight to the market's impact that we're seeing through the Asia session. And Tom, you were talking about what this does to the MSCI Asia Pacific, down 4%. Let's go more granular and look at some of these Asian markets, because the Kospi, as you've both been flagging, is certainly the epicenter of this, isn't it? Day two worse than day one. So down by 12%, because this is a market that was closed on Monday. So always playing a little bit of catch up here. But it isn't just the Kospi that's down. We're also seeing selling extensively across Japanese markets. I flagged the Topics and the Nikkei, both of those particularly weaker. And there seems to be a couple of things going on here. One is very much to do with what is happening in Iran and the higher oil prices. And of course, that has an impact on economies and countries that import oil. But also, you're just selling things that have done really well, in particular the Kospi, because even after all of this, we're still up 20% on the Kospi year to date. It's only March the 4th. So that just underscores how much strength we'd seen until this worst 2 days in the market since 2008.
How euphoric that rally had been, but it is unravelling fast for the Kospi. Interestingly, Korea, the world's 8th biggest crude consumer, hence why you are seeing the feed through from the US-Iran war here. You've also seen the Korean won selling off against the dollar yesterday. It's recovering somewhat today, but again, coming back to that Middle East risk. So
it's energy, it's stronger dollar, it's supply chain risk as well for South Korea and Japan. And to your point, to both of your points, major energy importers. South Korea had benefited, of course, from that conviction around high bandwidth memory, but there was leverage at play. That seems to be what we're hearing from Korean investors. There was a lot of leverage, there was a lot of margin, a lot of that is being unwound. And interestingly, the Korean authorities now readying potentially to intervene in the Korean markets after the biggest drop on record. The other part of this is to what extent, we have to ask, to what extent more broadly, the pressure that we're seeing across the markets, but also in prices up on oil and gas, to what extent that pulls Trump into the sidelines and raises the questions of whether or not, where is the pain point for President Trump when you look at the markets right now in terms of his view, in terms of how far he wants this conflict to go?
If there is a put, though, he doesn't need it on US stocks, because US stocks have, in the words of David Solomon over at Goldman Sachs, been quite benign in their response. You wonder whether that changes at all. I mean, US futures are pointing quite decidedly negative, but we have seen that before. I wonder if there's a link between tech in Korea and tech in the US. NASDAQ futures down 0.7%, although with such different tech landscapes that maybe that's hard to believe. European futures, you made this point, Tom, European futures do look quite resilient. I wonder if that holds, though, given the selling we're seeing in Asia, or does Europe feel like we've done enough of this and we need to factor in a little bit of the late in the day positivity we had out of the United States?
Well, as you say, it all comes back to oil. So Brent briefly topped $85 a barrel yesterday. It's now at 83, just shy of $84 a barrel. Clearly, this is the biggest shock to the market since the Ukraine invasion, and you look at the oil price. But the Strait of Hormuz remains all but shut. You had Trump saying that the US would provide insurance guarantees and naval escorts for oil tankers passing through the Strait to try and head off an energy crisis. Oil paring some of its gains briefly on the news, but then rising again, because just so many questions around how this is going to work. It's not clear who's going to buy the insurance. It's not clear what the premium would be from the US International Department Finance Corporation. I've never had to say that before, the DFC, but it shows that bigger role that they're playing now. What premium are they going to offer? Because it would be a massive undertaking for them potentially.
So question mark still about how how that process would work in terms of escorting vessels through the Strait of Hormuz, which remains effectively closed, and how that insurance system would work. So the proposition is there from President Trump, but now investors are asking those questions in terms of what the detail is of that. They're also asking questions in terms of what this is doing, this conflict, to the split with the US and some of his allies. And we saw another tongue lashing by President Trump yesterday, particularly targeting Spain, but also the UK as well. We've spoken, of course, to the Spanish foreign minister saying he wanted this process to go through the United Nations, and that's why Spain was opposed to the conflict that's being pursued by the US and Israel on Iran. But President Trump saying he wants to cut off all trading ties with Spain, and that brings us back to a question about exactly how. What are the mechanisms for that, given that Spain is, of course, a member of the EU?
Absolutely. So it's difficult to do when the competency to talk about trade in Europe is held by the European Commission. It's not devolved out to the... It's not something that the national governments do. Anna Botín, who, of course, has a lot of skin in this game, runs Santander and has just recently done a big deal in the United States to expand presence there. She's saying that the US and Spain will get back to their friendly relationship that has endured for centuries soon. We will see. But we are going to hear from the Prime Minister of Spain this morning, so I think that's interesting. And we'll watch Spanish stocks at the open. I mean, I was looking at the list of things that are exported. Wind turbines, olive oil, we won't mention wind perhaps, but petroleum products, aerospace, all of these things going from Spain to the United States.
Yeah, it's interesting to point out that, you know, it would have been easier to cut off all trade with the UK, but Trump sparing Starmer from that, saying that he's no Churchill, but as you say, still criticising him. I enjoyed your interview with Tobias Ellwood yesterday, really drawing the parallels between Iran and Iraq, just clearly the spectre of Tony Blair and the Iraq war hanging over the UK Prime Minister. But the Chancellor, Rachel Reeves, telling us that the UK won't make decisions on Iran to get better trade terms with Washington. Even before all of this, the OBR downgrading UK growth yesterday. Let's see what this war does to the UK economy.
Yes, and European countries then trying to craft a very careful line, and very different lines. Spain versus the E3, maybe, the E3 on a different page. And that has not escaped the attention of the Iranian foreign minister, who's been saying that some European countries risk appearing complicit. And so that will no doubt be something that is heard in governments around Europe. Let's tell you what else is coming up on the programme. We will be talking about oil, of course. We'll be joined by Carol Nakhle, who's the CEO of Crystol Energy. Bilal Hafiz, head of Macro Hive, will be with us. So we'll talk about the broader markets and the risk-off environment we've been caught in. Does that continue? Beata Manthi will be with us, European Equity Strategy Head at Citi. We've talked about their call to maybe hide out a little in UK stocks. We'll get an update on that. And Miguel Stilwell Andrade is the CEO of the Portuguese electric utilities company EDP. Does everything we're seeing in the Middle East just once again ask us to ask questions about renewable energy? Well, that's certainly going to be the focus of that conversation.
Let's take a look at what else we're watching throughout the day. At 10 a.m. London time, we have the latest euro area unemployment numbers. Then later, the European Commission unveiling its Made in Europe plan. So this is the Industrial Accelerator Act, which aims to boost European industry through new public procurement rules and local content requirements. Then at 7 p.m. London time, it's the Fed's Beige Book coming out. And then we've got more European earnings. 9 a.m. London time, Bayer, Campari at 4:45 p.m. London time. And then stateside, Broadcom and Okta reporting today.
Yeah, can US earnings cut through in that, quote, benign environment that we've seen so far for US stocks, if that is continued? Coming up on the programme, we will watch Spanish stocks, as we've been saying at the open, as President Trump threatens to cut off all trade with Spain after it denies, Spain that is, denies the US access to military bases for the war in Iran. Plus, the US President also ramping up criticism of the UK over the use of British air bases. Chancellor Rachel Reeves tells us military decisions won't be based on the prospects for future trade deals. We will bring you more of that exclusive interview with the UK Chancellor. Up next, oil extends gains despite the US promising naval escorts in the Strait of Hormuz. If you have any questions, get involved in that conversation or any of the others we're having around this desk. IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg.
Welcome back. We are, about 50 minutes or so, a little under 50 minutes from the opening trade this Wednesday. European futures currently flat, pointing low by about 0.1%, but looking to stabilise potentially after losses of around 4.5% so far this week on concerns around the Middle East. That is the picture. UK futures, let's say, looking to gain about 5 points. We'll see how that adjusts as we build up to the open this Wednesday. President Donald Trump, meanwhile, saying that the US will insure and escort tankers passing through the Strait of Hormuz. Reports say Iran is now claiming to have, quote, complete control of the waterway, and then it's warned global shipping networks not to sail through it. Meanwhile, Iraq is beginning to shut its biggest oil field, and Saudi Arabia's major oil storage sites are filling rapidly. Bloomberg's Jumana Besechi is in Dubai. Jumana, what is the state of play right now in terms of this conflict? Are we seeing an escalation? Certainly the lines around infrastructure in the energy space within the Middle East seem to be becoming pretty thick and fast. There's more detail in terms of some closures and shutdowns. Where are we in this conflict?
Yeah, well, the war seems to be escalating operationally and as it pertains to the reverberations on financial markets as well, particularly on energy markets. And President Trump is taking note. It's pretty clear that they're trying to do something about the Strait of Hormuz. He did announce yesterday that the U.S. are willing to provide naval escorts, insurance guarantees for the tankers and vessels that choose to pass through the Strait. However, the reaction from the markets, and obviously this is well received and would be welcome, is that it will be actually in effect quite difficult to implement, and it's unclear at this point whether any companies are going to subscribe to it. But one thing is for sure, there are major concerns, not just about rising costs in terms of insurance premia, shipping costs, but also in terms of actual security, with the Revolutionary Guard saying this morning that they still practically maintain control over the Strait. And as we heard yesterday, it's having an impact on some key OPEC producers. Iraq are already beginning to reduce some of their production. Saudi Arabia thinking of other ways to get their oil over to the Red Sea. They have a pipeline that can transport about 5 million barrels of oil a day. But all of this still having a notable impact on the energy market. At the same time, operationally, the joint U.S.-Israeli operations in Iran are amplifying. Yesterday, Israel targeted a building that houses this so-called Assembly of Experts. That's a group of clerics that are supposedly meeting together to think about who's going to be the successor to the supreme leader. His funeral is happening later today. And the CENTCOM, U.S. Central Command, saying that they have targeted over 2,000 main sites around Iran since the inception of this conflict. At the same time, Iran continues to retaliate a lot still against Gulf states. I will tell you that in terms of the intensity, it started to slow down, but they're still targeting key U.S. assets. Overnight, they targeted the Dubai consulate, hitting the parking lot there. They also targeted the CIA base in Riyadh. Riyadh saying that they intercepted almost a dozen missiles and drones that were heading towards various parts of southern part of the country alongside the east as well. And so this volley of attacks continue, perhaps with less of intensity and scale as before. But to answer your point, yes, this war has expanded, both in terms of economic implications and operationally.
Jumana, thank you very much. Bloomberg's Jumana Besechi joining us there from Dubai. Now, while the president's announcement, as we've heard, that the US will provide insurance guarantees and naval escorts for oil tankers reduce some of the risk premium in energy markets, perhaps, traders do remain sceptical about how any of this is going to come together. However, President Trump expects short-term pain for oil only.
If we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
President Trump speaking yesterday at the White House. Joining us now for more in-depth analysis is Carol Nakhle, CEO of Crystol Energy. Carol, nice to have you with us. Thank you for joining us. So if I start with the latest news flow, President Trump talking about providing insurance and naval escort, perhaps, to all kinds of shipping that wants to get through the Strait of Hormuz. I wonder what this will mean for the energy industry. A lot of voices suggesting that this isn't the only thing that's needed. We spoke to an insurance expert just this week who said getting insurance is only part of the decision that goes into whether you want to make that journey. But what's your perspective?
Definitely, when President Trump made the announcement, we saw a tiny bit of a relief because we saw oil prices easing by maybe $1 or $2. But it was just a question of time before they crept up again higher. So the announcement shows that the Americans are willing to provide support and protection to ships and tankers crossing the Strait of Hormuz. And there is also the political risk insurance that companies could get in case their own insurance providers don't provide that, don't offer that. However, is that enough for companies to really take this heightened risk? I'm not quite sure, because I'm not quite sure also about the practicality in terms of implementation, especially at the time when the war is simply expanding and escalating. But if we resolve the issue of the Strait of Hormuz and tankers resume their operations, I doubt, first of all, that we would go back to normality as long as there are bombs and drones flying above them or into them. There is the other very important and more worrying issue, that is attacks on energy infrastructure in the neighboring countries, and not just the energy infrastructure, but attacking those countries directly, which might lead to even worse scenario that involves dragging those countries, the GCC countries, into the war with Iran. So far, they have been protecting themselves, but maybe at some point, if Iran pushes it further, they might end up being dragged into the war, and that would be really a very bad scenario for oil markets and energy markets globally.
Yeah, Carol, does the market reaction to this proposal from the president suggest to you doubts about the implementation, or is it because it would presumably just cover US-flagged vessels, and so perhaps it's not enough to make a difference to global flows? Would we have a two-tier system here when it comes to oil?
Well, I'm not sure you're going to distinguish between the tankers or the vessels that are crossing the strait. If you have some support, it's going to ease a bit of the pressure and the fear. But let's see who's going to take those words and then act upon them, because there is still a risk, an important risk-taking measures. Now, we saw something, albeit to a much milder level, in the Red Sea, or when there were the pirates attack. But there you were dealing with very targeted group of pirates that were attacking the ships, or the Houthis when they were sending a couple of rockets here and there. That was implemented and protection was provided. There you have a much smaller space to operate. And also you are dealing with Iran, which I don't think until today it has used its most sophisticated vessels. So definitely it helps in terms of reducing the risk, but not really eliminated. There is still, the tensions are pretty high to see the implementation and seeing companies accepting to take that risk. Maybe if they start demonstrating with a couple of vessels, even if they were Americans, that would be good news. But let's wait and see how that is going to evolve practically.
Carol, good morning. It's Tom alongside Anna and Lizzy. Does the 10% increase in Brent that we've seen since Friday, does that accurately reflect the risk premium that we're seeing in the Middle East right now?
Well, it depends really on how people look at the risk in the Middle East. But I don't like to look at the situation in the Middle East without taking consideration the wider situation in global oil market, because we started the year with expectations of a notable surplus in the market. And therefore, what we are seeing today has caused some disruptions. Actually, every day we receive new news about further disruptions. So Iraq, for example, shut down its major oil producing field because they are lacking of storage capacity. So at the moment, the market is not panicking. We are seeing a justifiable increase in the risk premium and in oil prices, but there is no serious deficit to start with in global oil markets. We do have some cushion, from outside OPEC plus. Higher prices would encourage more shale production. It will not happen overnight, but it is going to provide some cushion, safety cushion. We do have the strategic petroleum reserves within the IEA members that can be activated if we are facing serious disruptions. We have a lot of oil unaccountable for, the sanctioned oil that maybe could come to the relief from Russia and still Venezuela today. So it's not a panicky stage. But again, if the situation further escalates and the war expands and the players in the region are dragged further into the war, then I would expect to see a worsening scenario when it comes to oil price. But at the moment, I think that is a reasonable reaction that we are seeing in prices.
And Carol, what's your assessment of how short we will be in terms of oil globally as a result of this? Difficult to say because we don't know how long this lasts. But if Iraq is shuttering, if Saudi Arabia is trying to use other routes to get some of its product to the Red Sea, if we are seeing the possibility that China, for example, could use coal instead, I mean, all of these moving parts no doubt still add up to a shortage. How big is that shortage?
It's very difficult to pin a figure on that because you have to envisage all sorts of scenarios. But the good news is the following. There is some alternative, even if not fully available, to absorb all the tankers, let's say, and the volumes that you would normally trade through the Strait of Hormuz. But you can divert some of those barrels, several million barrels a day, let's say, through a land infrastructure that the countries in the region have implemented. Even Iraq, they do have the option in the north via Turkey. But again, they do have some issues, but so that it's not immediately available, but they can work on it to make it, to open it, and then send some of their oil to the global oil market. And at the same time, we should not only think in terms of supply, because we started the year with a not so great outlook when it comes to oil demand. So oil demand, yes, was growing, but was rather limping rather than growing at a fast rate. Higher prices are going to dampen further the growth in oil demand. So while, yes, we will have some shortages in supply, which can be compensated for to a certain extent, but it might take some time to see that effect because of the lag that we have, whether for production in the US or using alternative infrastructure for trading oil from the Middle East. But also there is a demand factor where we might see a slowdown in demand growth, and that could put if you want, a lid on how far prices could go higher if the situation does not end anytime soon. It does not get resolved.
Carol, always appreciate your analysis. Carol Nakhle there, CEO of Crystol Energy, with Brent just shy of $84 a barrel. Well, here's what else you need to know this morning. Bloomberg understands Russia is dismayed by US and Israeli attacks on Iran, but feels mostly powerless to aid its ally and sees potential benefits for its war on Ukraine. We're told Moscow believes demand for air defense missiles from Gulf states means there may be fewer resources for Ukraine. And in the last few minutes, Decision Desk HQ says State Representative James Tallarico has beaten Congresswoman Yasmin Crockett in the Democratic primary for the US Senate. In the Republican primary, US Senator John Cornyn and Texas Attorney General Ken Paxton look to be heading for a runoff. And Bloomberg has turned that more than 25 senior leaders across Blackstone collectively pitched in some $150 million to the Blackstone Private Credit Fund. That, along with $250 million of the firm's own capital, went to help cover a record redemption request of roughly $3.8 billion, or equivalent to around 7.9% of net assets. So it just shows how far these managers are willing to go to quell investor fears, retail investor fears about the cracks in the industry. But when is that papering?
It's pretty remarkable that managers are, as we describe in the story, door knocking of the managers at Blackstone saying, can you chip in to what is a flagship fund? It's a bellwether fund for the industry as well. Look, this is a fund that attracted significant inflows last year. And I think it's interesting you point out that this is the retail investor concern, because there seems to be a split. And certainly there are those in the industry who say, look, institutional investors, they're still committed. It's the retail investors where you're starting to see some panic to the point where Blackstone managers are having to chip in about $150 million of their own capital to ensure that they can meet these 7.9% redemptions.
And the extent to which retail investors should have exposure to private credit and private funds generally is still a live conversation, obviously. Really interesting, the Bloomberg Invest Conference, and we heard from a lot of the titans of the industry talking about pain still to come, some putting a time horizon on this of 18 to 24 months, and some, of course, probably talking their own books, but suggesting that the way through all of this is a diversified firm. If you're not only lending to AI, or if you're not skewing toward lending to software, then you don't suffer quite the same AI threat.
But to your point, the institutional investors saying, look, this is how it is, kind of shrugging your shoulders somewhat. Apollo's Mark Rowan saying openly, if you wanted a higher dividend, you took more risk. Basically, if you want to ride the wave up, you've got to ride it down as well. Yeah, and the fundamentals, we still don't have evidence that the fundamentals in terms of the assets that are exposed to are fundamentally cracking. We're seeing that in the public markets, but these are privately held assets, of course, within the software space. That's where the concern is. Coming up, as stocks sink around the world, Bilal Hafiz from Macro Hives tells us how markets are pricing the Iran story. That's coming up. This is Bloomberg.
30 minutes from the start of cash equity trading. This is Wednesday the 4th of March, and the futures picture looks a little more positive for Europe than it did this time yesterday, that's for sure. We were substantially weaker during yesterday's session, down 2-3% on some of these major markets on European equities. The US story was much more resilient, so towards the end of the day, or even just the latter half of the day in the States, we saw a little bit of a recouping of earlier losses, so maybe we're just pricing in some of that. I wonder how long that lasts, because US futures are pointing down once again, Lizzy. So that's the story in stocks. Yesterday, the bond story was all about higher yields.
Yeah, and the bond sell-off continues today. Yields up again across the curve, across the European continent, more so notably than for treasuries. We had seen double-digit basis point moves higher for gilts yesterday, so we'll wait for those to open as well. But traders starting to price in an ECB hike and pricing out one of the 2 BOE cuts that they were looking at for this year, Tom.
Yeah, inflation risks, of course, and that's tied to what's happening in the gas price and the oil price, but prominently for Europe, of course, the gas price. Today, European gas prices are up just shy of 2%. They're up about 75% since the conflict started. So there's that context, of course. So 55 per megawatt hour. That is the pricing right now. So up just 2%. So again, a little bit more stability. You're seeing a bit more stability in equity markets. And I was saying a little bit more stability in terms of the gas prices. Oil around $83 a barrel on Brent. So we'll see if that lasts, of course, and the headline risk remains. Meanwhile, Spanish Prime Minister Pedro Sánchez is due to make a statement at 8 a.m. UK time. That's after US President Donald Trump said he will cut off, quote, cut off all trade with Spain. The threat comes after Spain denied US access to their air bases for Iranian strikes.
I told Scott to cut off all dealings with Spain. They were the only country that in NATO would not agree to go up to 5%. I don't think they wanted agreed to go up to anything. They wanted to keep it at 2%, and they don't pay the 2%. So we're going to cut off all trade with Spain. We don't want anything to do with Spain.
We don't want anything to do with Spain. Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, how realistic is this? What does this do to US-EU relations?
Yeah, I think it's really going to complicate things, Tom, if this is a serious threat. Again, we take everything that Donald Trump says with a grain of salt, particularly on these sort of wild tariff threats, particularly since all of those tariff threats are sort of undermined by that Supreme Court ruling. But the other person you didn't see in the frame of that shot was Chancellor of Germany, Friedrich Merz, that was sitting next to Donald Trump. And really his number one mission going to Washington, D.C. before this war started in Iran was to get clarity on the sort of tariff policy, the legal groundwork on which the United States would be operating their tariff policy in order for the Europeans to be able to restart the ratification progress of their trade deal. And of course, the other issue was Ukraine. These are the two main issues that really for the German chancellor were the priorities going into this meeting. Of course, it was totally overshadowed by the situation in Iran. They were both sitting there in the Oval Office. Most of the questions went to Donald Trump, but Friedrich Merz did manage to say a few things for the few seconds that he got to speak in the Oval Office. Have a listen to what he had to say about Iran.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible. And we are hoping that the Israeli and the American army are doing the right things to bring this to an end and to have really a new government in place who is coming back to peace and freedom.
Yeah, something had to be done. And it's been 47 years.
And so you hear it there from the Chancellor Merz. So of course, the main sort of preoccupation for the Europeans in terms of the knock-on effect is, as you were highlighting there, Tom, the rising in prices of natural gas. That, of course, is a sensitive topic for the Germans, which industry has, of course, been so decimated over the last few years from the increase in oil, or I should say, the prices of gas from the sort of Russia situation, now getting further compounded by the situation in Iran. But what has also been interesting is seeing the sort of fracturing we're seeing across the political spectrum within Europe. We have the UK, France, Spain to a very large degree being critical of the United States and their activity within Iran. Germany has been much more on board with the U.S. and Israeli actions, really sort of standing behind it. That being said, this is not a situation any European is sort of comfortable with, but we should remember that the sort of Europeans, certainly the Germans, are held hostage to a certain degree by the United States and Donald Trump because they continue to need the support on the issue of Ukraine, and I doubt that they really got that much airtime in discussing the situation in Ukraine, which really was the second most priority for Friedrich Merz heading to the White House for this visit.
Ollie, thank you for the update. Our Chief Europe correspondent, Oliver Crook, there. Well, turning back to the market reaction now, Asian stocks have plunged the most in nearly a year, led by the biggest South Korean crash ever. This is mounting concerns over the Iran war trigger an exodus from some of the world's best performing markets. For more, we're joined by Bilal Hafiz, Head of Market Strategy at Macro Hive. Bilal, good to see you. So many places to go, but I feel like the big question is, do all roads lead to inflation in the short term, in the long term, higher oil prices, higher defence spending? Is the market pricing around central banks correct?
Well, I think certainly all roads do lead to higher oil prices, and there's also the broader supply chain shocks. What's less clear is whether we have pure inflation or whether we also get a demand shock as well. So then you have this stagflationary outcome, and each economy around the world will contend with this in different ways. But in general, this is an inflationary shock, and we basically need to see how long the oil shock lasts for it to kind of have a broader impact on inflation expectations and then work its way through the system to raise inflation.
We'll take Europe then specifically. I remember a time a few news cycles ago when you were talking about euro dollar at 140. Now you're seeing it at 114 within the month maybe. How realistic is the pricing that the ECB hikes this year? I think it's more than 60% now.
Yeah, I mean, I think the ECB is in a very tough situation because the energy disruption will really hit Europe in a dramatic way, which will then impact growth, which would make the ECB dovish. But then the inflationary side would then lead for them to be hawkish. My bias at this stage is for them to be relatively neutral. I think the market pricing could well change very easily. In terms of the dollar, I think at the moment the dollar is heavily bid, and that's why we have this view that the dollar will, euro dollar could head down towards 115. Longer term, I'm still of the view that the dollar is in the midst of a long-term downtrend, so eventually the dollar will weaken, but right now is not that time to play that theme.
Interesting.
Bilal, good morning. So that's the oil story, the inflation story. We're also thinking about stocks and how they chart a course through all this geopolitical uncertainty, and sometimes stocks are quite resilient to that. We had a conversation with one guest yesterday. We were going back to the 1970s and thinking about parallels for stocks there. You take us back in your notes to the 90s and you suggest maybe there are parallels there. I mean, different geographies are handling this very differently, but what are you seeing in the sort of history books that tells us anything useful about where stocks go now?
Yeah, it's a great question. I mean, we looked at other Middle Eastern conflicts or those or North African conflicts that have parallels to today. The two that seem to be most relevant is obviously the Russia-Ukraine conflict and then also Gulf War I. During Gulf War I, interestingly, that's where even US stocks did tumble for a relatively prolonged period of time, i.e. a number of months. That also coincided with the US recessionary type dynamic. Russia-Ukraine, on the other hand, saw short-lived equity weakness before it bounced. And I think my sense is that investors at the moment are using the Russia-Ukraine playbook and then also taking the view that this will be a short-lived conflict, and that could well be wrong. I think people are erring too much on the side of a very quick resolution, whereas the Gulf War I may be the better analogy.
And does it make sense for the assumption to be that the US is more insulated from this? Its role in the oil markets has changed markedly and actually could benefit from higher oil prices and more exports of some of its energy products. And that resilience we're seeing in US stocks, therefore, does that really make sense? And is that something we lean into?
I mean, there's two things there. You know, number one, I think at the moment we're seeing significant amount of de-risking and position unwinds, and investors had essentially piled into global stocks away from the US over the last few months. Global stocks have outperformed the US, so we're seeing an unwind of that, which is making the US look attractive. That said, you're right, US does have an energy surplus. It does meet a number of those tick a number of those boxes, but the big engine of US equity outperformance has been all the big tech stocks. And the problem what we're seeing now is if we do get this energy hit, then the whole AI story, which is partly underpinned by energy, gets hit quite significantly. And so that could challenge the US story going forward.
And that's interesting, Bilal, in terms of the unwind that we're starting to see. And European stocks are still just about outperforming the S&P year to date, but of course have underperformed since the conflict started. In terms of the European corporate story, and you kind of touched on this with inflation impact and the impact on growth, do we need to start rethinking the earnings outlook for European corporates on the back of, one, weaker euro, and two, higher energy prices?
Yes, I think we do. I mean, again, this all sort of depends on how long this conflict lasts, how elevated energy prices will be. But assuming they remain elevated for a longer period of time, for sure that will impact your European markets and corporate earnings. We saw that during the Russia-Ukraine crisis, and Europe just doesn't have the resilience to deal with an energy shock. China, we know, has coal and other sources of energy. US obviously has its own energy production, so Europe will be hit quite significantly, and this will then impact consumers. You get a recessionary type dynamic, and then you have all of those impacts on earnings.
How much concern are you hearing from clients? I mean, if we have that Gulf War I scenario that you outlined for us, where do you hedge? What are you telling clients in a scenario like that?
Yeah, I think for now, my bias would be, the dollar will do well in this type of scenario. One is sort of defensive in general, so one tends to favour countries that are away from the Middle East, energy producers, so Canada, US, Swiss franc, if you wanted to sort of pick one in the currency markets. Bonds, I think, are very difficult right now because you have this kind of fight between safe haven recession versus inflation. And then on equities, I'll just stay on the sideline on the equity side. One market, I think, that does, in the end, I think will be more resilient than most will be China. Because although it does import a lot of energy from the Middle East, it just has so much sources of resilience and it manages its markets a lot more aggressively than others. So for me, China is the one that I think will end up being one of the more stable markets throughout this whole crisis.
Well, you take us to Asia. We've seen this plunge in Korean stocks. Is that an overreaction? Of course, it's tied to the energy story as well, but you were talking about how traders are dropping the trades that were winning and the AI story as well. If the outlook in the Middle East improves even just incrementally, would you see people rushing back into that trade?
I think at the moment we're seeing a large amount of de-risking. So that essentially means that we'll get an exaggerated moves to the downside. So if we do see some stability, we could see some sort of shorter-term bounces. That said, I think this really does hit the Korean story in a significant fashion. We saw this exponential move up in Kospi, and now we're seeing this big drop. So I'd be reluctant to buy into any dips on the Kospi side, given the energy impact.
Can I ask about China? You mentioned how China could be an area of resilience. I mean, that is interesting because there's been a lot of focus on a lot of the Iranian barrels were going to China. Now, China's stocked up a lot on energy in the run-up to this. We understand a lot of their storage. People were wondering where they were putting it, and are they able to take any more?
Unlike the Europeans, it seems.
Right, exactly. And for gas in particular, left lower than 100% after into the winter rather. So why are you convinced then that China is going to be as resilient, so resilient?
Yeah, I mean, number one, I think China just has an incredible hold on the global supply chain system. It really knows all the routes really well. It's got all sorts of built-in redundancies as well. So on the energy side, it has coal, has nuclear, ramped up its solar energy as well. It has all sorts of other routes to be able to access energy. It's built up its inventory too. So I think China has all sorts of means to kind of get energy from different sources. And then outside of that, China is involved in all sorts of trade routes around the world. It's basically the largest player in pretty much every single trade route in the world. So it can reroute everything much more effectively than almost any other country in the world. So I think China, in that sense, has this redundancy built into its system.
You haven't mentioned gold yet, Bilal. It's been bumping around kind of 5,200 per troy ounce. It briefly broke above 5,400 earlier in the year, didn't hold above that level, and kind of bouncing around 5,200. Is there another breakout for gold, or is it kind of capped at these levels? Do you want to be adding gold in this environment?
Yeah, I mean, my kind of sense on gold is that initially it was a victim of position unwinds. Gold had done incredibly well. People had unwind position, gold gets hit. If this conflict does continue to last longer than everyone thinks, then I think gold will go higher. And I think there's parallels with the other wars that we've had. There's also big parallels with the 1970s. And back in the 1970s, you had multiple oil shocks. You had a change in the international financial system. You had, higher deficits coming off the Vietnam War. And gold did incredibly well over that decade. So I think all of those things come into play. And gold could go way higher after this.
Bilal, thank you very much. Thanks for joining us. Bilal Hafiz, head of Macro Hive. Now, the UK Chancellor tells Bloomberg you can't trade principles for deals.
You can't make a decision about whether to get British armed forces involved in a conflict because it may or may not make it more likely to get a trade deal.
That's the UK Chancellor Rachel Reeves talking exclusively to Bloomberg. That was following the spring statement. Of course, we'll have more coverage of the conflict in Iran. That's coming up next. This is Bloomberg.
this is going to be really, really hard. And I just think market participants are dealing with an enormous amount of uncertainty.
Right now, it's just too soon to know what imprint this has on inflation and for how long.
Inevitably, the world that we're living in may change geopolitically. We may see realignment of alliances. Energy prices has a big impact. We may see inflation come back in.
Woke up or the market opened up down 1,100 points, and now it's come back. It speaks to the resiliency and robustness of the market.
Some of our guests at Bloomberg Invest in New York reacting to war in the Middle East. Joining us now with his perspective on markets, our Markets Live executive editor, Mark Cudmore. Mark, it seems as if we're seeing quite a lot of geographic divergence in terms of the response to this new geopolitical threat, to war in Iran. It's been an incredible session in Asia, a lot of negativity, a lot of negative prints on the screen. Is it over, do you think, by any stretch?
I think, first of all, no. The negative impact from the conflict in Iran is not over. And that's because we're just not going to have an easy, full flow of energy from the Middle East for a good while to come. I know there have been promises made, re potential insurance, re potential escorts for boats. That's still going to take, even the most optimistic scenario, that's still a few days away from being implemented, and probably quite a while before we get a full flow of energy. So we've got some sort of energy shock that's still going to feed through to markets. And you've got to remember the context where we've been. It's an incredible day in Asia. Some of the size and scopes are immense. The worst day for Korean stocks ever. It's the worst. They've only had 2 trading days, and it's already the worst month for Korean stocks since 2008. Quite dramatic. But on the flip side, the stock market in Korea is still up more than 20% year to date. And I think that's the context you got to remember, is that when you look at year to date moves, most assets seem to be doing phenomenally well, which kind of justifies the idea from David Solomon that it's been a benign reaction so far. This does not look like a year where we've had a major multi-nation war fully involved in the US and the Middle East and a sort of energy shock. It looks like overall and year-to-date assets doing pretty well, and that's the context in which you need to see this. So therefore I think we get much more of a correction across assets over the coming weeks, significantly more, but I don't think that's a sudden panic-mongering bear market. It's just that, hey, the year has been bizarrely good up until last week, and we've got more of a correction to come.
Mark, in that context, we have gold up today. Bilal Hafiz just told us that it's got further to climb, but you don't agree?
I disagree. Now, I think he might be talking in a much longer term horizon. Sure, central banks don't want to buy. Some of the longer term themes are there. But in the short term, and what I mean by the short term, I mean the next couple of weeks or so, I think gold's got quite a bit of downside. I think there were 3 primary reasons, marginal reasons for buying the dollar recently. One is geopolitical risks. Well done. If you bought for geopolitical risks, you got your big multi-nation war, one of the biggest wars we've seen for some time. Therefore, the trade is run. What more are you expected from now? Just, we've already got full US engagement. We've got multiple nations being struck by missiles. So that trade's run. The other one, if you're doing to diversify away from the dollar, well, we're about to get it. We're in a dollar bull market again now. Maybe not a bull market, it's maybe a bit of a stretch, but we're in a dollar strengthening environment for as long as the conflict lasts. And that will go much further. So you don't want to buy it right now to diversify away from the dollar. And the third one is just the idea that, hey, all these momentum stocks are doing so well, things like the Kospi, etc. So you therefore just pile into all the momentum trades. Well, that one's now blowing up. Just look at your monitor. That's blown up over the past week. So the 3 primary reasons recently for the last kind of few months of gold have all changed. Dollars reversed, yields reversed, geopolitical thing has run its course, and the momentum trades have blown up. So therefore, I think gold's got quite a bit of downside for the next couple of weeks.
OK, Bloomberg Markets Live executive editor Mark Cudmore, thank you. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by looking at MLIV Go on your terminal. Let's check in on the futures picture, because it's looking pretty positive, in fact, for Euro Stoxx 50 futures, up 0.7%. Pointing lower stateside, S&P E-minis down 0.2%, but weakness expected on the Spanish IBEX after, of course, President Trump said that he would cut off all trade with Spain because Spain denied access to its military bases for his bombing campaign against Iran. We're waiting for remarks from the Prime Minister of Spain, Pedro Sanchez, coming at the top of the hour, Tom.
Yep, Spain in the spotlight as well in that context, of course. Let's bring Chloe Melly right now with some of the stocks to watch this Wednesday. Chloe.
Good morning, Tom. Oil companies are very much in focus today. We have seen oil prices extending those gains because of this fresh attacks in the Middle East, but also because energy traders are weighing up, considering that plan by Trump to escort and inshore oil tankers that are passing through that region. So we could see those oil companies moving higher, even higher than they have been over the last couple of days. Today, it is worth noting that energy traders are wondering about maybe the lack of clarity around that plan by Trump, asking what those military escorts actually look like, what this actually looks like in practice. So this definitely will be a sector to be keeping an eye on today. Moving on to another related story, and that is Maersk. The shipping company is adding an emergency rate increase on shipments to and from some Middle Eastern countries. And so we had already seen Maersk shares moving higher since the beginning of the conflict because, of course, these tensions mean that container rates might be moving higher, and that is good for those earnings for Maersk. And so we could see those shares extending those gains today and also being in the green. And finally, ASM is also in focus. It issued quite an upbeat outlook last night thanks to strong demand for AI, but then also a recovery in the Chinese market. So that could boost the shares. But it is also, there could also be some negative read across with some of those chip makers in South Korea seeing a lot of weakness. So let's see how this shakes out and what the market actually decides to focus on today for ASM.
Okay, thanks very much, Chloe. Good to get the updates. Bloomberg's Chloe Melly there. We've also seen updates, of course, from Adidas and Continental. So certainly the German market, we'll keep an eye on those and their earnings stories. Do they cut through on a day like today? Actually, the DAX looks as if it could be a little firmer, unlike the Spanish IBEX, which doesn't look firmer, looks negative for reasons we well understand.
Yeah, Adidas forecasting higher profits and promising bigger payouts. Continental seeing higher margins on the demand for high-end tyres. But it's a bit like the UK spring statement yesterday. How long do these earnings outlooks last? The longer this war goes on and the energy price outlook starts to, and the euro-dollar outlook starts to feed into earnings pictures.
To what extent do we have to reframe how we think about European corporate earnings? The question had been, up until this war in the Middle East, will euro strength be a constraint? Now we're looking at euro weakness and what that means in terms of the inflationary impact for many of the importers within the European corporate space. So that maybe needs to be reframed. We are coming up, of course, to the opening trades this Wednesday. Futures pointing slightly higher in Europe today. Stay with us. This is Bloomberg.
Welcome, everybody. Welcome to Wednesday's programme. We are a few minutes from the opening trade here for cash equities. And the European session is going to be an interesting one. There are a number of really contrasting inputs going into this. This is the session in the United States yesterday. And actually, after Europe closed, we saw a little bit of strength continuing to be built into US stocks. Now, is that irrelevant to the European story? Well, European futures are pointing quite a bit higher. We'll separate out Spain. That's a different story. Tom has more on that. But they are pointing higher. And that's in contrast to what we've seen in Asia, where we saw MSCI Asia Pacific down by 4% by the end of the day. The Kospi under a lot of pressure there. So it's despite what we've seen in Asia. It's also despite, Tom, what we see in US futures, which are pointing lower still. But the European futures picture does look positive.
Yeah, looking through that significant sell-off that we've seen in the Asian markets, to your point. And a sell-off, of course, yesterday of around 3% for European stocks. Today, pointing higher, futures by about 0.6%. It was banks, it was financial services that were most under pressure yesterday. Today, there's a little bit more resilience, it seems, but we know the headline risk, of course, continues around the conflict in the Middle East. FTSE 100 futures pointed to gains of just 18 points. The IBEX is in focus for us, of course, because President Trump says he wants to cut off all trade with Spain. We'll see if that actually materialises. The complexity of doing that, given that Spain is part of the EU, is a major question. But nonetheless, risk building in to Spanish stocks, it seems, currently pointing lower by 0.9%. What are the individual names you're looking at, Lizzy?
Well, Tom, we've got to keep an eye on the energy sector because of President Trump's proposal that you could see Navy escorts for ships, oil tankers passing through the Strait of Hormuz. Also that the US could provide insurance guarantees to try to head off this energy crisis. But still so many questions about who's going to buy the insurance, what premium the DFC will offer. You flagged Spanish stocks, also watching Adidas after their earnings, Anna.
Yeah, absolutely. We've got some earnings from some German corporates. A lot of volatility in that Spanish futures picture as we head towards the market open. And European equity markets then just getting into their stride. The IBEX doesn't usually take too long to open, so we might get a fairly early print there. But the FTSE 100 just fluctuating between the red and the green. The futures had settled into something quite positive overall for Europe, so we are expecting to go a little bit higher. How long that lasts, we have US futures pointing a little bit to the downside, although the US equities space has not been the epicenter of the selling by any stretch when it comes to Iran-related equity risk. Now, we do have an opening price on the CAC 40. It is up by 0.2%, and we have weakness as expected in Spain, down by 0.7% over on the IBEX. I was looking at the list of exports, covers a lot of sectors of product going from Spain into the United States. But Tom, a lot of confusion as to whether it would even be possible for the United States to cut off Spain specifically, carve it out from European trade policy. But anyway, what are you seeing in the wider stocks this morning?
Right now, media is gaining, up 1.1%. On the downside, interestingly, given the context, of course, we are seeing just 5 sectors right now in negative territory. Energy is down 0.8%. You've seen Brent stabilising, at least for now, around $83 a barrel. Energy is now down at 0.6%. So it's the biggest loser so far, at least. On the upside, travel and leisure, that has been a sector that's been under significant pressure. Hotels, airlines, of course, the closures of airspace in the Middle East. Media up 1%. Tech gaining as well. You've seen a bit of resilience to your point around what's happening in the US. The tech space has been something of a haven for some. Tech as a sector is up 0.9%. Names like ASM in focus and seeing some gains, at least, in the session today.
Well, if we just dip into the energy sector, so you've got BP down 1%, Shell down 0.7%, Total only flat to the downside. You mentioned travel, Tom, and of course earlier in this war we had seen big losses for the airlines, but Deutsche Lufthansa actually up 0.9% today. Air France KLM up more than 1%. I'd flagged the earnings story for Adidas, those shares down 1.8% despite forecasting higher profit and promising bigger payouts. Dassault Aviation up 1.8%. They had earnings as well, but you, of course, would expect this to be tied more to the broader geopolitical story. We wait for Conti to open up as well as Bilfinger. But it seems in the defence space, it's a mixed bag, actually. Leonardo is up 1.7%, but the likes of Rheinmetall and Hensoldt today, Anna, in the red.
It's interesting that energy stocks are weaker, and I was just looking back at where the oil price was when we closed yesterday, because it's been so volatile. I know it went over $85 a barrel at one point yesterday, but it was at 83-ish when we closed yesterday, and it's about there now. And these moves to the downside in energy are not huge. I guess it just reflects the fact that the market's focus is elsewhere today. It seems to be on buying those stocks that have been really beaten up. I see travel and leisure as an area of strength, a bit more emphasis on, well, I was going to say away from airlines, but actually you've got TUI up 2%, Accor up 2%. These were airlines, aviation companies, or travel companies rather, and hotels that had been beaten up on the Iran story. So we seem to be buying back a little bit at the margins, some of those areas that were under pressure. Let's bring in Beata Manthe, Head of European Equity Strategy at Citi, and really nice to have you with us this morning, Beata. Thanks for joining us. So we have an interesting session underway here in Europe where we see a bit of resilience coming back into European equity markets. I wonder if this is just a holding pattern. Are we just waiting for more headlines to drop? A new headline risk, as Tom, you were talking about earlier, is no doubt still in our midst. What are you expecting to see from European stocks from here?
Absolutely. So there is still a huge amount of uncertainty. It feels that the market wants to bounce and assumes that this conflict is going to last for a short period of time, and there is going to be resolution. So, of course, the hopes got higher with the yesterday announcements from the President Trump. Well, let's see how fast that can happen. But because what we are seeing for now is that nothing is going through the Strait of Hormuz, right? And as long as the Strait is closed, there will be upside pressure on oil and natural gas prices, and probably some volatility in the equity market. Yeah. But indeed, it is interesting that today we are buying marginally the previous losers. Right?
Yeah, as you say, just marginally. What kind of playbook are you reaching for then, Beata, for this? We talked to Bilal Hafiz earlier on, who was saying that 2022, Russia's invasion of Ukraine seems to be very much at the forefront of investors' minds, and he sees evidence that that's what people are reaching for this time around. Does that make sense from a European stocks perspective? Are there parallels with that?
when it comes to the performance that we've seen, well, in the 2 days, I cannot believe it's been only 2 days of the working and trading week, right? We see really the market following the pattern, the playbook of Ukraine. Right. So this is, well, except from today. Let's see how these are early minutes. Let's see how the day finishes. But if you look, I'm going to give you some numbers from our commodity strategy on comparison of Ukraine crisis to this one, potentially. With Ukraine, initially, the world has lost 5 million barrels of oil. Soon after, it was only 1 because 4 managed to find its way through other channels. Strait of Hormuz is 15, so potentially 15 times bigger for the oil disruptions than Ukraine crisis, right? Ukraine war. So that's something to bear in mind. And of course, that's the assumption of the market that the situation there in the Strait has to be sorted one way or another.
Yeah, maybe because the stakes are so high.
Absolutely.
Yeah.
So stakes are much higher there for the commodities than they were in the Ukraine.
We had a piece out today, and it quoted analysts saying that the taco trade is dead. Trump always chickens out, but not when it comes to this conflict because he has less control over it. Do we buy into that? There is surely a pain point for this president, whereas gas prices at the pump, they're already at a 5-month high in the US, or a significant sell-off in US equities, which, to Anna's point, we have not yet seen. But is there a point at which the markets intervene to some extent, or at least constrain this president in terms of his military ambitions?
Well, it's hard to say when it comes to the military conflict. With tariffs, it's something different, right? This is much more serious, potentially, from the security perspective. And we don't know enough about their strategy. They are not giving us enough information to assume that. But definitely, the market is acting this way. But the US is not the only player, right? There is the Middle Eastern players as well, and there is Israel, who play a role in the conflict.
So we can't assume on a Trump put at this point?
You could, and perhaps you shouldn't, right?
Yeah. Okay.
Because the situation is quite fluid and it's far from resolved.
You put out a note at the start of this conflict suggesting that the UK could be more resilient in this conflict scenario. Why?
So on Sunday, we were thinking, because everybody has been positioned for risk on, for cyclicality, for the diversification trade from the US. And when it comes to geopolitical conflicts, the UK tends to be the biggest hedge. Why? It's a triple whammy. 50%, 50, of its weight is in defensive, so that helps. Then it has a big weight in oil, of course. And the last one, it has the biggest weight in defense, aerospace and defense companies, almost 10%, so triple whammy. However, I'm surprised it still outperforms the other cyclical markets, not the US, and that's the function, of course, of them being more immune to higher prices. They are self-sufficient when it comes to oil and gas, and of course they sold off a lot. And right now, it's not only defensiveness, but also sold off quality that the market is seeking. Right?
But what if this war keeps going on and oil keeps getting closer to $100 a barrel, and traders price out not only BOE cuts, as they already have started to do, but they start pricing in BOE hikes, as we're seeing in the ECB?
Of course, so this is why this crisis has to stop fast and soon, right? So when it comes, so the conflict has to last for at least a quarter. So all the prices for energy have to be high for this period of time to have an effect on inflation. So 10% on nat gas and 10% on oil for around staying there for 3 months. That's around 35 basis points extra on inflation for the Eurozone. That's the translation. Of course, well, we could go very fast for more than 10%, right? So that's the risk.
What about Spain? So we're seeing weakness for the Spanish IBEX today after the president's threat to cut off all trade with Spain. We've pointed out that perhaps that's harder to implement, Spain, of course, being part of the EU. Do you price that as a realistic threat, or is this an overreaction that we're seeing today?
I think it is just another news flow right now that the market is paying attention. Let's see how it plays out. There are bigger things at stake right now when it comes to security of the nations than this point, right? But of course, the IBEX has been one of the best performing countries. Well, year to date in Europe and globally, right? So as I said at the beginning, you are seeing a big unwind of these very good trades, very strong trades. Investors are taking profits, and it's logical, right, given the uncertainty.
Yes, and those profits have been made. So we are watching the Spanish Prime Minister speaking right now in the face of those trade threats from President Trump. Spain saying no to war, in the words of the Prime Minister. Opposes breaking international law and says the Iran war won't lead to a fairer world. So we're bringing you these live pictures coming to us from Madrid of the Spanish Prime Minister speaking now. In terms of the sectoral breakdown, then, going back to the Iran impact, Beata, and what that does to stocks around Europe. I mean, luxury, if you're looking for companies that actually have revenue exposure, it's not actually that high, the revenue exposure, is it, to the Middle East region? But it's just for some companies, they have a lot of exposure, I suppose. I'm thinking of luxury. There's a lot of money in this region, so luxury names, chemical companies.
Absolutely. So chemicals probably is one of the sectors with the highest exposure. For luxury, it's probably 5-6% overall. It's double what it is for the overall European index. So it's not nothing, right? And it's definitely a further disruption for the sector that have already been facing many headwinds in terms of demand beforehand.
Beata, always a pleasure to have you. Beata Manfrey there, Head of European Equity Strategy at Citi. Thank you very much. Well, let's check in on the core six now. We were just talking about luxury. LVMH, actually one of the names that's in the green this morning, high at 0.5%. Losses, though, today for Rheinmetall after we saw gains for the defence sector earlier in the week. But it's green across the screen for most of our names in Europe this morning. A contrast to previous days, but it looks like we are inching into a more risk-on mood today in Europe. Let's dive into some of the other individual stocks on the move today. Chloe Melly is here with more. Chloe.
Good morning, Lizzy. It seems that ASM is doing pretty well. We're up almost 5% this morning for that chip-making equipment manufacturer, and that is because it issued a very upbeat outlook last night, and that is thanks to strong demand from AI customers for its equipment, but then also a recovery in the Chinese market that is seen as quite positive. So we are very firmly in the green this morning for ASM. Not the same can be said for Adidas, which is down this morning quite significantly, almost to 7%. So it's actually forecasting higher profits in 2026, expects to gain market share, is also promised bigger payouts, but it is down this morning because it seems that the profit expectation was actually below that analysts had expected, and so we are seeing quite a lot of weakness in that stock this morning. Same is the same for Continental, which also has expected higher margins, but it seems that there are lingering concerns around the fate of ContiTech, which is the unit that has been trying to sell, and so we are down a little bit this morning for Conti, about 1.7%. D'Ieteren is up this morning. It is in the green after it was said to have appointed Rothschild to explore options for its controlling stake in Belron, which is a car repair business, and some of those options include an IPO in either the US or Europe, and so this update is being taken pretty well by the market, up almost 2% this morning. And finally, the UK house builder Vistry is taking a major hit this morning, down more than 20% after the CEO is set to retire, and the earnings were a little bit disappointing. And so we're down very, very significantly for that company this morning.
Chloe Melly, thank you very much indeed for some of the stocks on the move this Wednesday session. We're checking back in on what we've been hearing from the Spanish Prime Minister, who has been clear in his opposition, of course, to the war against Iran pursued by Israel and the US. The latest lines then coming through from the Spanish leader saying that Spain demands an end to the war, and the end to the Iran war. That is according to Pedro Sanchez, the Prime Minister. Spain will work with Middle East countries that favour peace, he says. The war in Iran won't lead to a fairer world, according to the Spanish Premier. And Spain, again, the Spanish Prime Minister reiterating that Spain opposes breaking international law. Of course, we heard from President Trump yesterday in the Oval Office saying that he wanted to cut off all trade with Spain because of Spain's opposition to this conflict, though, of course, the complexities of doing that remain a significant question.
Yeah, absolutely. And so as a result, we see some weakness on the IBEX, although recovering from earlier losses and now nearly back to flat on the Spanish markets. Coming up, oil very much still in focus. Oil extends gains despite the US promising naval escorts in the Strait of Hormuz. We will have the latest on that story next. This is Bloomberg.
if we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before.
President Donald Trump speaking yesterday at the White House during his meeting with the German Chancellor Friedrich Merz. Meanwhile, oil extended gains as fresh attacks flared in the Middle East and traders weighed a US plan to ensure and escort tankers passing through the Strait of Hormuz. Stephen Sapczynski, who leads our Asia energy coverage, joins us now from Singapore. Stephen, good morning. How's the market pricing the different routes this conflict could take now?
Well, I mean, I think right now the market is still likely pricing in a somewhat short-term conflict. I think there are a few things that the market is looking at very closely. So there are two really key points. One is the Strait of Hormuz. Obviously, that is something that oil tankers and gas tankers have largely stopped traveling through. And then two is what's the impact on the surrounding infrastructure? Because if the Strait of Hormuz were to open tomorrow, okay, trade, it continues, fantastic. But the thing that the market is closely monitoring is there damage to infrastructure. There was an attack on Saudi Aramco's largest refinery, an attack on the large liquefied natural gas export facility in Qatar. There's also questions about other infrastructure pipelines. So the market wants to know if the Suez were to begin and travel were to continue and you could get all your insurance figured out, would the flows continue? Would there actually be any impact on the physical barrels being exported from these countries?
What does that tell us about the plan to have naval vessels, presumably largely US naval fleet, in the Straits of Hormuz to escort these ships? Like this has been done before, not under this administration, of course, but there is a playbook, I guess, to some extent for this. If we look back in history, is that to what extent would the markets take reassurance from that part of the story?
It would be part of the reassurance, but I think when you look at Hormuz, there are a few different issues. So clearly there is a security threat. And if you do have, some sort of guarantee from the U.S. or a Navy assisting with the ships going through, that would alleviate the issues surrounding security. The second is just insurance, right? If you have the ships going through, does that change the calculus for insurers? Because that's been a very big issue as well for these ships. Going through the Strait, getting their war coverage, it's actually going to be ending later this week. So are owners of ships willing to pay higher insurance rates? Are the insurance rates going to decrease if you have that guarantee? Trump also said that he could insure. He could use U.S. insurers to assist with that as well. But the details of that are also fuzzy. So it is one aspect of it. But I think there's also just an expectation of what's going to happen next? Because Trump says a lot of things. Will he actually deliver?
Stephen, thank you very much indeed. Stephen Sapczynski, who leads our Asia energy coverage. European gas prices up just 4% so far in the session, but up about 75, close to 76 or so percent since the start of the conflict. Now, to what's happening in the private credit and private equity space. Some of the leaders of Wall Street's biggest private markets firms have been weighing in on the challenges facing the industry. Apollo Global Management CEO Mark Rowan told Bloomberg, we should expect a shakeout in the private credit markets.
The entirety of the companies that you see that are public today, everyone was $40 billion in 2008.
Yeah.
We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term.
This will be a shakeout. It may not be short term. Rowan speaking with Bloomberg editor-in-chief John Micklethwaite at the Bloomberg Invest Conference in New York. For more, let's bring in our senior reporter, Silas Brown, who's been covering the private credit unravelling to some extent, at least, if that's the way we frame it. There was this pretty remarkable story about Blackstone and some of the managers there having to kind of dip into their own pockets around what is a flagship fund. How unusual is that, Silas? And is there more of that to come, do you think?
Yeah, I think it is unusual, but I think it's symptomatic of where we are when it comes to non-traded BDCs in private credit, which is a source of about 250 billion of AUM in the industry. I think investors, no matter how much the leaders of private credit defend the solid performance of the asset class, which I think it is fair to say, investors can't seem to shake the feeling that we're at a late stage of the credit cycle.
Is that mostly retail investors?
It's mostly retail investors, and I think they're quick to point out that institutional investors are still, kind of open to the asset class. But I think the difficulty with the retail investors is that because of their courting of the retail investors, they've developed these vehicles that allow them, a small portion of liquidity, and no one's quite worked out what will happen when they want a big portion of liquidity and what to do. And at the moment, I liken this moment to a sort of like high finance's version of a blinking contest. No one wants to be the first to tell investors that they can't withdraw the amount that they want. And they're going to great lengths to avoid being the first. And I think Blackstone is a kind of a relatively good example of that.
Yeah, that's really interesting that you took us in that direction, Silas, because I was drawn to actually some comments from Goldman Sachs yesterday that said limiting, so we haven't seen anybody blink in your terminology, but Goldman Sachs saying that limiting fund withdrawals is a feature, not a bug, of private markets. As if the fact that it's supposed to protect assets from fire sales, so to be able to shutter them is entirely the point. In their view.
And this
so how will that play out?
this is like the central. I mean, it's kind of almost funny because no one disagrees with the principle of gating in the industry. Everyone thinks it's a very good thing, and I think for pretty solid reasons. I mean, it basically, it's an illiquid asset class. It does protect people from fire sales, and yet there's a kind of real reticence to use it, and there's a real reticence in the industry, even though people are going over the 5% threshold, to say to investors, that basically it's a very placating environment for investors.
Why is that, though? Because, you can't offer more liquidity to the people who've bought the product than there exists in the underlying assets. Isn't that the basics?
I think it's a febrile time. I think people have seen what's happened, to fund managers. Blue Owl has kind of gone through a lot of the brunt of this, and they've seen the risk of being the first to do this sort of thing. And I think reputationally, people are trying to work out quite how impactful that will be. And so I think, look, I think if I was a betting man, and if I'd, knowing people in the industry, I think the amount of redemption requests that will come in the next quarter will be more rather than less of this quarter. And so I think that, at some point someone is going to have to blink, but it hasn't quite been yet.
Exactly. Just going back to Bloomberg Invest, you had Soros Fund Management's Dawn Fitzpatrick saying it's going to be a painful 18 to 24 months for private credit and private equity. Surely this chipping in to paper over the cracks can't continue much longer.
Yeah, well, I mean, I think it's also fair to say that actually what's quite eerie about this time is that private credit performance has remained relatively flat and quite strong. I mean, like Blackstone itself, I think, it was about, I think, over 9% of annual returns since inception for BCred's fund. And I think you haven't yet seen among the larger managers a kind of an impact on performance. And yet, I think it's fair to say, look, it's a very bad environment to sell for private equity, and that should have an impact on private credit.
Silas, thank you very much. Silas Brown, our senior reporter. Oil prices at $83 a barrel. Seems a good time to talk renewables. We will talk to the CEO of EDP. That conversation is next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and we are seeing a modest rebound for European stocks this morning after a steep two-day decline. So breaking with the mood that we've seen in the Asia session earlier and with what we're expecting to see in the US session later on. Particular weakness, however, coming out of Spain. We have had remarks this hour from the Spanish Prime Minister responding to President Trump's threat to cut off trade with Spain. Fighting talk in response from Pedro Sanchez, and you're looking at the IBEX down nearly 1% this morning. Tom, what are you seeing under the hood?
Yeah, headline risk is still there. We're hearing from Iranian officials just in the last couple of minutes saying that the war can continue. They're not having any talks with the US. But to your point, there is a bit more stability across the European space today, and you're seeing that in terms of the breakdown between the laggards and the leaders, in terms of the members as well. So you have currently, as things stand, 337 members in positive territory. A very different dynamic to yesterday, where of course you had a significant number of individual names significantly lower, and across the benchmark drops of around 3% by the end of the close. Today, across those members that are lower, 238. Volumes also higher but less in terms of the spike that we saw yesterday. We saw a much more significant spike in volumes yesterday. Today, volumes about 17% versus at that 20-day average. In terms of some of the individual names, on the leader side, it's tech as a sector that is top of the list right now. Banks under pressure. Tech, so ASM over in the Netherlands, ASML, of course, the maker of lithography machines. You've seen a bit of resilience in terms of the tech space in the US, and that starts to be feeding in to the European space as well. For how long, of course, because the supply chain challenges are also there. Up 1.4% then on ASML. SAP in the software space, interestingly, of course, because that's been a focus prior to the war of the software sell-off, currently up 1.2% for SAP, listed over in Germany. Let's flip the board and have a look at some of the laggards then. We're looking at the individual story. This is an idiosyncratic story, really, Adidas, in terms of the forecast. This is not linked to the conflict as much as it is to concerns about the forecast and currency effects, tariff effects as well for Adidas. And so that's selling off pretty sharply in terms of that retail company, down at 6%. Bayer, the chemical space, of course, lower by 3.4%. And BP, the energy stocks, a little softer in the session today after the rally that we've seen since the start of this conflict. BP currently down 0.9%. Anna.
Tom, let's get an update on the wider news flow this morning. Asian stocks have plunged the most in nearly a year amid mounting concerns over the Iran war. In South Korea, the Kospi dropped, closing down 12%, its biggest drop on record. Bloomberg understands several Chinese financial firms are scaling back exposure to Middle Eastern debt as hostilities raise concerns over China's extensive lending in the region. We're also told regulators are tightening up checks in parallel. And President Donald Trump says he's directed Treasury Secretary Scott Bessent to cut off all trade with Spain. The move comes after the European nation denied access to its military bases for Trump's Iran bombing campaign. A few moments ago, the Spanish Prime Minister Pedro Sanchez says his country won't change position out of fear of retaliation and called for an end to the war.
European gas prices are up 70% since Friday's close as the conflict in the Middle East chokes shipping through the Strait of Hormuz. This level of market volatility has not been seen since the 2022 energy crisis. For a context from the corporate perspective and a company that has exposure particularly to the renewable space, let's bring in Miguel Stilwell Andrade, CEO of EDP. The stock is up about 50% in the last 12 months. Thanks for coming in. How is this conflict in the Middle East impacting your business?
Well, first, thanks for having me. I think the first thing to say is obviously it's introducing a lot of volatility. And so we're seeing something that is at the early stages similar to what happened back in 2022. But I think really the important thing is that this just highlights how important it is to be diversified from an energy perspective. And so one of the things we've been advocating for many years now is the investment, for example, in renewables, which is much more insulated from these type of exogenous shocks. And so for many years, we've been a leader in the clean tech space. We've been investing in renewables both in Europe and in the US. And you have actually a fantastic example in Portugal, which is more than 75% renewable generation, and which managed to navigate through the crisis back in 2022. And so I think we'll also navigate through this crisis, basically as a result of having a lot more sources that are not exposed to this type of volatility in the market.
To your point, Europe is vulnerable. We don't have the stockpiles of energy. We know that inventories around gas are low. Oil, of course, is an impact. We import significant amounts of oil into Europe, into the UK as well. Are you hearing from investors, are you hearing from governments a greater urgency to invest in renewables as a result of this conflict? Do you expect greater inflows? Do you expect more investment? Do you expect more interest?
Yes, we do, and that's something that we've been seeing actually over the last couple of years. As I say, going back to 2022, it became very clear that the issue around energy independence diversification, affordability, and competitiveness, all those issues are very conducive to actually investing more in renewables, where you actually can take advantage of your natural resources without having to import fossil fuels from outside. So we've been seeing that push, and we think that will be just strengthened really by what we're seeing today.
So if the war means the relative economics of wind and solar have improved dramatically, how fast can you fulfill that demand?
Listen, we've been pushing to invest 2-3 times faster than actually what's been happening in the past. I think one of the big bottlenecks that has existed over the last couple of years has been a lot of the administrative and bureaucratic, red tape that a lot of times makes it difficult to actually build out these projects. And so we've been saying and advocating you need to be much faster in cutting the red tape, making sure that you can fast track these projects so that you can actually reduce that energy dependence on fossil fuels.
And how exposed are your supply chains to the conflict and the closure of the Strait of Hormuz effectively?
So more than 90% of our generation is actually renewables, either hydro, wind or solar or batteries. So our exposure is actually relatively limited. We are also very low risk because we have a lot of long-term contracted revenues, either from our networks business, which is totally regulated, or our sort of PPAs with our renewable sources. So actually from a risk perspective, we are relatively de-risked from this type of conflict.
So you paint a picture there of quite a bit of visibility then, which sounds like a positive, and many businesses probably don't have a lot of visibility right now. I noticed, I think just recently you've been tweaking your CapEx guidance, and I wonder what your appetite for CapEx looks like right now. With on the one hand, a lot of volatility, but on the other hand, you're in an industry that maybe is structurally set to benefit from that volatility. So what do you do around CapEx with that in mind?
So we have over 12 billion euros projected to invest over the next 3 years, and most of that is going either into networks to make them more resilient or going into renewables, as I say, into the US or into Europe. I think it's not just the issue around volatility. One of the big macro trends that we're seeing is just an increase in demand for power coming out of AI, data centers. All of that is driving that demand. And so we are seeing tremendous opportunities to actually invest to supply that power for those AIs. So I think it's actually a great time to be in the sector because you're not just having all of this demand, which is obviously positive, but I think it's also very plugged into increasing this energy independence.
So a number of structural shifts then playing to your advantage. I wonder, the conversation in the United States around renewable energy is so influenced by politics right now. There's a lot of that, and there's a lot of commentary from the White House specifically on renewables. Does that just absolutely have no impact here in Europe because of the things that you've talked about, because there's European commitment to energy security and because of AI build out? Does that mean it just doesn't cross the Atlantic?
Yeah, I don't think it crosses the Atlantic, but to be fair, even in the US, I think there's a difference between actually what's happening on the ground and some of the rhetoric. On the ground, what you're seeing is a tremendous amount of demand for power, and actually the type of supply that can be deployed the fastest and sort of the most competitively is actually solar and batteries in the very short term. So we're actually seeing a tremendous amount of demand. It's one of the best times actually we've seen over the last 20 years to invest in the US in this space, precisely because of this demand. So I think I would separate some of that sentiment and rhetoric from actually what's on the ground.
And to be clear, that's really interesting in terms of the demand picture in the US, given the politics that Anna talks about. Is the federal government not getting in the way then? Because they've been getting in the way of renewable turbines. We know that. Are they getting in your way at all in terms of meeting that demand?
So one of the things that was actually established last year with the Big Beautiful Bill was this framework, which essentially they kept out till 2030 of support for renewables. And primarily, I'd say solar and batteries, which is continues to be sort of a big part of our business there. So the truth is that we are continuing to see that regulatory stability there, and they are not actually getting in the way. So if you actually look at the numbers, there's a tremendous amount being installed as of today and expected to be installed over the next couple of years.
And you've touched on AI, and clearly the US is leading in terms of the build-out of the infrastructure and data centers around AI. Give us a projection in 5 years' time, or 2 years' time, what percentage of your revenues come from serving data center demand?
Well, from our renewables business, it's either directly, sort of our biggest customers globally are Amazon, Microsoft, Google's, those are our typical customers, but also utilities that themselves are having then sort of this additional load coming through from the big tech. So it's actually a very significant percentage. But what I'd say is that demand is driving, 2-3% CAGRs, compound annual growth rates over the next 5-6 years plus. So that's a very attractive environment to be investing in. And that's true on the renewable side, but it's true also on the network side. And so just to give you one very interesting statistic. In Portugal, for example, we're actually seeing a huge amount of investment as well in data centers. Just one data center in Portugal is going to represent 20% of Portugal's consumption. Wow. So over the next couple of years, you're going to see that really drive that demand in the country.
Given all of these changes to the backdrop, do you still hold to saying that there won't be any M&A?
Listen, I think we are very comfortable with the plan that we have. We think it's a plan that is solid, built on organic growth. As I say, very attractive investment opportunities, and so we are steering our path.
Okay, focusing on organic growth. Miguel, thank you for joining us in the studio. Miguel Stilwell Andrade, CEO of EDP. Well, turning to Spain, the Prime Minister Pedro Sanchez has been speaking in Madrid, saying that he won't change his position and demanding an end to the war. We're joined now by Bloomberg's Chief Europe correspondent, Oliver Crook. Ollie, are we seeing a splintering of EU nations when it comes to Iran?
Yeah, they're certainly getting some different views from a number of different nations from across Europe, and really the Spanish have been the most outspoken over the last few days after those strikes in Iran commenced over the weekend, with the government saying effectively that the war was sort of an illegal operation and that basically all the sort of international rules should be respected, and really coming out quite aggressively, and especially on the show yesterday when you spoke to the Spanish foreign minister, against U.S. and Israeli action within Iran. We've just heard from the Prime Minister of Spain, who, as he was saying, he basically is not going to change his position on the threats that Donald Trump made yesterday, saying that effectively the United States would put a full trade embargo on Spain, and effectively that could complicate another conversation that is very sort of present in the minds of Europeans here, which is that the European Parliament today is supposed to vote on whether or not to continue unfreeze the process of ratifying their trade deal with the United States. Of course, as we know, the trade is not negotiated at the individual level for these European nations. It's done as a bloc, as a whole. So if this threat by the United States is taken seriously, this could delay yet again trying to get that trade framework moving forward, which has been obviously first derailed by Greenland, then by the Supreme Court ruling that basically dismantled the sort of core of the Trump tariff policy. And of course, this is the issue that the Chancellor of Germany wanted to seek clarity of from the President of the United States yesterday when he was in Washington, D.C., and I doubt very much whether or not he was able to do that. That being said, you've had the French also and the UK indicating that the strikes by the United States might have been illegal within Iran. But of course, there's always the Ukraine put from the Europeans. There's only so far they can go because they still do need support from the United States and Donald Trump in their support of Ukraine. So it's a very delicate balance, but we're starting to see where the red lines are for the Europeans. We learned where they were on Greenland. We'll wonder where they are here on Iran and on trade.
Yes, and so really interesting to see the different stances being charted, the different courses being charted by these countries. Now, France and the UK have been talking about sending military presence to assist for various reasons, specifically around Cyprus and protecting Cyprus, but also in the French case, talking about shielding Middle Eastern shipping and using military assets to try and do that. What's the latest there, Ollie?
Yeah, so the French are deploying a number of different ships. There was a sort of early in the events with Iran over the weekend, we understood that the French were sending some more naval ships to support a sort of EU mission that was in the region. But most recently, we heard from Emmanuel Macron, who addressed the nation last night, saying that they will be deploying the aircraft carrier Charles de Gaulle towards in the Mediterranean, towards the east of Cyprus. So the sort of main sort of position for this that the French are sort of suggesting, this is about safeguarding economic interests, economic assets, and of course the French, of course, have got assets within the region. But I think that we have to see the other side of this. This is also about creating a reaction function from the European side when there is a military threat to Cyprus, an EU country, that the French are willing to step up and deploy their military operations. That is not really just a message to the Iranians. That is a message to the Russians as well, to say what the reaction function is at a time when the Europeans are very concerned about whether or not the United States would have, they would enjoy the full backing of the United States if there were any infractions on NATO. So I think it's very much also about telegraphing that to the Russians. That being said, we should also say that any other news cycle, when the French government is talking about expanding their nuclear arsenal, talking about deploying their military capabilities and their nuclear capabilities in neighboring European countries, admittedly on a temporary basis, that would really be headline news. And that is exactly what happened yesterday. We are now having conversations from the Polish Prime Minister saying that Poland is considering developing its own sovereign nuclear capability. These are massive changes in the sort of framework and the way that we think about European defense that at any other time would get more coverage. But again, it's all being sort of overshadowed by the situation in Iran. But there are enormous things and enormous conversations happening on the European continent, particularly on nuclear deterrence.
Yeah, really significant. And President Macron, to your point, really kick-starting that conversation about the European nuclear umbrella. Oliver Crook, thank you very much indeed, our Chief Europe correspondent. Coming up, we will bring you the latest on the state of play in the energy markets as the US promises naval escorts in the Strait of Hormuz. You've had a bit of calming in terms of European gas prices in the session today, at least. More on that coming up. This is Bloomberg.
Welcome back to the opening trade. 8:48 here in London, and we see European equity markets overall in the green, but we have moderated those gains. We're up just 0.2%. Weakness still coming through in the Spanish market. That seems to be an area of focus, but that related, of course, to trade and the geopolitical situation in Iran as well, but related to President Trump's threats around trade when it comes to Spain. Let's get back to Iran and what is happening there. Iran says it has no intention of negotiating with the United States. An advisor to the late Supreme Leader told Iran's state-run television channel that they have no trust in the Americans. Bloomberg's Jumana Basechi is in Dubai for us. Jumana, bring us up to speed with the latest. Iran saying then that it can continue this war for as long as necessary.
Yeah, that's right. Not backing down on their resolve to keep retaliating against the ongoing strikes that the joint U.S.-Israeli operations are having on Iranian target sites. The Central Command saying that they've hit over 1,000 sites, over 2,000 sites, I should say, across Iran since the inception of the war. Israeli ongoing operations continue as well. And yesterday, they actually targeted a building where supposedly there was we were going to see a meeting of this assembly of exports, or so that's what they're called, the group of clerics who were planning on meeting to decide who was going to be the successor to the supreme leader. Now, in return for that, Iran says that they will keep on retaliating, specifically targeting U.S. assets in the region, and the resolve is not really diminishing in that respect. They're reiterating, this is something they said earlier in the week, that they don't plan to negotiate with the United States. So what we're seeing here is what some people are describing as a war of attrition, and to see which side's munition can hold out longer in addition to their defense systems. And the longer this goes on for, the less perhaps we'll see in terms of frequency of attacks, and more targeted, impactful attacks should be expected. At the same time, one of the calculations that Iran is making is that they're going to inflict so much economic costs, not just on Arab countries, but also around the rest of the world, that there will be calls for this to de-escalate somehow.
And in that war of attrition, of course, Jumana, as you well know, Gulf states are being drawn in, and they are in the middle of that war of attrition. How are Gulf states reacting in this moment?
Yeah, so far they've been acting in a self-defense capacity. It was interesting to hear from the UAE yesterday. They did a very special, extraordinary press conference with multiple ministries represented. And what they said essentially is that they have managed to successfully intercept almost 1,000 drones and ballistic missiles that have been directed towards the UAE. That's 1,000, a huge number, just contextually. And that they reiterate the right to act in self-defense, but also the act to respond. And I think, we're beginning to get a different tone out of some of these Gulf states, especially now that over the course of this week, some of their key infrastructure sites have been targeted, energy infrastructure, as we've been talking about, logistics hubs. The airports is still barely functional at this point. And so, yes, the economic costs are mounting. The hope, of course, is for an off-ramp for a diplomatic solution. But I think if you listen to both the language and also some of the actions taken by these individual countries, the UAE closing down its embassy in Tehran, the Saudi Arabia calling on the Iranian ambassador, it does suggest that we've entered into a different phase now. And the Gulf states will have to make perhaps some difficult decisions about whether they will actively seek to reopen those diplomatic channels or somehow even respond even more forcefully, given the bombardment, the daily bombardment that comes through from Iran.
Shamana, thanks for the update. That's Bloomberg's Shamana Basechi in Dubai. Should be back with Horizons Middle East and Africa at 5 a.m. London time tomorrow. We are looking at Brent back above $84 a barrel now. But let's take a look at what else we're watching throughout the day. At 10 a.m. London time, we'll get the latest euro area unemployment rate. This interesting to get a read on the labour market before the impact of the war on the economy. Traders already starting to price an ECB hike this year. Later on, the European Commission will be unveiling its Made in Europe plan. Then at 7 p.m. London time, we'll get the Fed's beige book. Could give us some insight into how businesses are interpreting the Supreme Court's rejection of tariffs, of course. And then earnings will be continuing throughout the day. We get Bayer at 9 a.m. London time, Campari just before 5 UK time, and then stateside Broadcom and Okta reporting, Tom.
OK, let's get back to the markets and bring in Bloomberg MLive's Skylar Montgomery-Koning for a take on what we're seeing. Skylar, we're seeing gas prices in Europe higher by just 2%. So in the context that we've seen since the start of this week, pretty modest. There seems to be some equilibrium maybe being found in the gas pricing, still up about 75% since this week. To Lizzy's point, Brent is back above $84 a barrel. How are you thinking about... We're seeing a bit of stability in equity markets. Is that tied to what we're seeing in the energy price markets? Were we finding some stability and sustained stability in terms of how markets are pricing this?
I think now that we've had that surge higher in energy prices, and it was very substantial, right? From the lows on Brent, you're up something like 40%. So you know those have economic consequences. What you don't know at this point is what the policy response will be. So you don't know, are we going to get fiscal to help energy prices out in Europe? Are we going to get monetary policy that skews more hawkish as a result of that? And so I think now we're increasingly thinking, well, how high or long are we going to have energy prices stay high? Are we actually going to have U.S. ships start helping transit through the Strait of Hormuz? And so there's more questions now. And so I think you then take a chance to pause and reassess what you're thinking about. And you also think about what are the starting conditions. And risks very much look asymmetrically skewed to the downside from that for bond markets, for example, because if you think about European inflation data earlier this week, that came in hotter. So if your starting point is hotter, that skews risk to more inflation. And so we'll look at ISM services later today and the prices paid component with that in mind.
Yeah, and I wonder how bond markets chart through all of that, because with all this talk about inflation, we've seen bond yields go higher. We certainly saw that over the last couple of days in Europe. And today, also, we have yields going higher, just not as dramatically as they were for the last couple of days. It's interesting hearing the UK government talking about being there for families and consumers if they need to be, and maybe other European governments, as you mentioned, could also want to help out. But that's going to be, something the bond market's going to be paying attention to, isn't it? But at the moment, not too many jitters around that kind of narrative.
Yeah, I think it depends on whether or not energy prices stay elevated for quite a significant period of time. I think, too, part of the bond market reaction you're seeing is the fact that yields were very low heading into this. Particularly in the U.S., you had 3 cuts priced this year, which seemed very high considering that the economic backdrop was one of strong growth and core PCE around 3%. And so this just adds those inflationary wins. I think particularly in Europe and the UK, because there's so much fiscal concern, because their markets, especially the UK, that tend to be more reactionary, more negative, it is, very concerning the prospect that you would get more spending.
OK, so we watch that fiscal response to what's seeing in terms of the economic damage of the war in the Middle East. Bloomberg, Skylar Montgomery-Koning, of course, in terms of the market reaction. There is a bit more stability in the European equity market today, up 0.2% on the benchmark Stokes 600. US futures, though, pointing lower by 0.3 on the S&P E-minis. Fed Governor Stephen Myron, on that Fed conversation, of course, that Skylar was talking about, is on surveillance at 1:30 p.m. London time. So that would be a pretty fascinating conversation for his take.
Yeah, how convinced is he still that we need rate cuts in this environment? That certainly will be a conversation to tune in for. 8:56 here in London. European equity markets then just edging higher, but they're giving up a lot of those earlier gains. US futures point lower, down 0.3% on E-minis. That is it for Wednesday's programme. The Pulse is up next. This is Bloomberg.